September 23, 1998, Greenwich, Connecticut. Inside a glass-walled conference room, John Merriweather stares at a screen showing a number that shouldn't exist. Negative $4.6 billion. Around him sit two Nobel Prize winners, a former Federal Reserve vice chairman, and some of the most brilliant mathematical minds Wall Street has ever assembled. 4 years earlier, these men had built a money machine averaging 40% annual returns. Now, in just 16 weeks, they've lost everything and are hours away from triggering a global financial meltdown. The Federal Reserve is scrambling to organize an emergency bailout, not to save long-term capital management, but to save the entire financial system from their collapse. The bias that destroyed them? It's the same one that makes you hold losing stocks, double down after bad trades, and whisper to yourself, it's due to turn around. You're probably using it right now. To understand how the smartest people in finance drove themselves off a cliff, you need to understand what long-term capital management looked like at its peak. Founded in 1994 by John Merriweather, the legendary bond trader from Salomon Brothers, LTCM wasn't just another hedge fund. It was an intellectual dream team. Myron Scholes and Robert Merton, who would win the Nobel Prize in Economics in 1997, designed the mathematical models. The strategy was elegant. Find tiny price discrepancies between related bonds, bet that those gaps would close, and use massive leverage to turn small profits into enormous ones. For 4 years, it worked like magic. Investors who put in $10 million in 1994 had nearly $40 million by early 1998. The fund managed over $100 billion in assets with only $4 billion in actual capital. That's 25-to-1 leverage. Banks competed to lend them money. Investors begged to get in. The model said risk was minimal because the trades were hedged, and history showed the patterns always reverted to normal. But cracks were forming that nobody wanted to see. In early 1998, spreads between bonds started behaving strangely. The models predicted convergence, but gaps widened instead. Small losses accumulated. The partners noticed but reassured themselves. Temporary anomalies, noise in the system. The math would prevail. It always had. Here's where trading psychology becomes critical. What was happening inside those brilliant minds? Two cognitive biases were working in lethal combination. The first is the gambler's fallacy, the belief that past patterns must continue, that outcomes are due. When a roulette wheel lands on black 10 times in a row, something in our brain screams that red must be next. But the wheel has no memory. Each spin is independent. LTCM's models were sophisticated versions of the same mistake. They assumed that because bond spreads had always converged historically, they would converge again. The past guaranteed the future. The second bias is overconfidence, the tendency to overestimate our own abilities and underestimate risks, especially when we've been successful. LTCM had Nobel laureates. They had the most advanced mathematical models in existence. They had never been seriously wrong. This created a dangerous blindness. Think of it like a surgeon who's performed 1,000 successful operations, becoming convinced they can't make a mistake. That confidence doesn't prevent the mistake. It prevents them from seeing it coming. In the minds of LTCM's partners, failure wasn't just unlikely. It was theoretically impossible. Their genius had become their greatest vulnerability. By summer 1998, the anomalies LTCM had dismissed were becoming wounds. The fund was down 14% in July alone. But instead of reducing positions, the partners did something that reveals behavioral finance in its purest form. They doubled down. The model said the trades were more attractive than ever. Spreads had widened beyond historical norms, which meant the eventual convergence would be even more profitable. This is exactly how the gambler's fallacy operates. The longer the losing streak, the more convinced you become that a win is imminent. Merriweather and his partners weren't panicking. They were excited. They saw opportunity where they should have seen danger. Then, on August 17th, Russia defaulted on its debt. Nobody at LTCM had seriously modeled this possibility. Their systems had labeled it a 6 Sigma event, something that should happen once every few million years. But here's what the overconfidence bias does. It makes you dismiss scenarios that don't fit your worldview. Russia's default triggered a global flight to safety. Investors everywhere dumped risky assets and bought US Treasury bonds. Every single one of LTCM's positions moved against them simultaneously. The fund lost $550 million on August 21st alone. In a single month, they lost almost $2 billion. The models kept saying to hold, to wait for convergence. But the market wasn't reading the models. What happened next is a masterclass in how cognitive biases compound under stress. As losses mounted, the partners faced a choice: admit the models were wrong and cut losses, or trust their systems and wait for the inevitable reversion. They chose to wait. They even tried to raise more capital to double down further. This is the sunk cost fallacy merging with overconfidence. We've come this far, we can't be wrong. The math will save us. By mid-September, the fund had lost over $4 billion. Their leverage, already dangerous, had become catastrophic. They were so large that selling their positions would crash markets worldwide. The Federal Reserve had to organize 14 major banks to inject $3.6 billion, not to save LTCM, but to prevent their collapse from taking down the global financial system. The smartest people in the room had built a bomb they couldn't defuse. Now, here's what matters for your own investing. You don't need Nobel laureates or billion-dollar leverage to fall into the same trap. The gambler's fallacy and overconfidence bias show up in everyday financial decisions constantly, and they're costing you money you don't even realize you're losing. Consider what happens when a stock you bought drops 20%. The voice in your head starts reasoning. It can't go lower, it's already down so much. Now is the time to buy more. This is the gambler's fallacy in your portfolio. The stock doesn't know what price you bought it at. It doesn't owe you a recovery. But we average down on losers while selling winners because we're convinced patterns must reverse. Or think about how you evaluate your own investment decisions. When trades work, you attribute it to skill. When they fail, you blame bad luck or market manipulation. Over time, this selective memory builds a mental image of yourself as a better investor than you actually are. You take larger positions, you ignore warning signs, you become a miniature version of LTCM, convinced your track record makes you immune to disaster. The same pattern appears in career decisions. Maybe you've stayed in a declining industry because you've invested years there and believe a turnaround is due. Or you've held onto a business strategy that stopped working because changing course feels like admitting failure. The bias doesn't care about the domain. It operates the same way whether you're managing a hedge fund or a household budget. So how do you fight a trap that feels like logic? The answer isn't more intelligence. LTCM proved that. It's building systems that force you to act against your instincts. The difference between traders who survived 1998 and those who didn't wasn't IQ. It was whether they had predetermined exit rules that removed emotion from the equation. Before entering any position, define exactly what would prove you wrong. Not vague discomfort, a specific price, a specific time frame, a specific condition. Then automate the exit if possible. LTCM's partners kept moving their mental stop losses, convincing themselves each new low was the bottom. A written rule committed to in advance breaks that cycle. Behind every financial collapse is someone who stopped looking for evidence they might be wrong. Meriwether's team surrounded themselves with people who shared their models, their assumptions, their confidence. Actively seek out the smartest person who disagrees with your position. Not to argue with them, but to genuinely understand their reasoning. If you can't steal them in the opposing case, you don't understand your own risk. The most dangerous phrase in risk management is, "That could never happen." LTCM never modeled Russia's default because it seemed impossible. Before major decisions, run a pre-mortem. Assume the decision fails catastrophically, then work backward to identify what caused it. This isn't pessimism. It's the only way to see risks your confidence is hiding from you. Finally, separate your identity from your positions. LTCM's partners weren't just invested financially, their entire reputations and self-concepts were tied to the fund's success. When your ego is on the line, admitting error becomes psychologically impossible. Treat positions as hypotheses to be tested, not extensions of your worth as a person. Not everyone fell into LTCM's trap. While Meriwether's team was doubling down, Seth Klarman at the Baupost Group was doing the opposite. Klarman, who managed billions in assets, had a simple rule. Never use models to talk yourself out of obvious risks. When spreads widened in early 1998, he reduced positions instead of adding. When Russia defaulted, his fund was insulated. What made him different wasn't superior intelligence. Klarman's system included mandatory stress tests for scenarios his models called impossible. He forced his team to ask, "What if we're completely wrong?" before every major position. That systematic humility, built into the process rather than relying on individual willpower, was the difference between catastrophe and survival. LTCM's collapse wasn't about complex derivatives or obscure math. It was about human minds doing what they've always done, seeing patterns that aren't there, trusting past success too much, and believing disaster is something that happens to other people. The gambler's fallacy and overconfidence bias took down Nobel Prize winners. They can certainly take down the rest of us. The question isn't whether you're smart enough to avoid these traps. You're not, and neither am I. The question is whether you've built systems that protect you when your brain inevitably fails. If this made you think differently about one decision you're currently facing, this video did its job. Subscribe if you want to keep pressure testing your assumptions with me. Here's what I want you to consider. What position are you holding right now? Not because the evidence supports it, but because you've already lost too much to quit.